Hello and welcome to this week's Australian Share Market Report. I'm Dale Gillham, Chief Analyst at Wealth Within. This week I'll be discussing how to achieve better returns with less risk, the All Ordinaries Index and this week's stocks of interest. Before we jump into the report, I'd just like to mention that if you have any thoughts on investing, please comment below and subscribe to our channel so you keep up to date with our new content. So let's get into this week's report. When trading the market, one of the most important factors is managing your risk. To minimise risk, investors attempt to diversify their portfolios in any given sector or industry in an effort to protect their capital. Too little diversification leads to higher risk, and too much diversification leads to overexposure and ultimately poor returns. Let me explain. Portfolio theory suggests that you should invest in a range of different equities to spread out your risk. This generally means to invest in different sectors of the market and to do so by investing in many different companies. I generally agree with this. However, too much of any one thing is bad, and an over-diversified portfolio, as I talk about in my book Accelerate Your Wealth, ultimately will lead to diversifying your portfolio. Research into portfolio theory suggests that the optimal number of positions held in a portfolio is between 8 and 12. With each additional position after 12, the reduction in specific risk is minimal, while systemic risk continues to rise. This leads to an over-diversified portfolio. It is not uncommon for me to see portfolios containing anywhere from 15 to 50 different positions, which is far more than you need. If you have an over-diversified portfolio, over time, you will find that 1/3 of the stocks in that portfolio will be rising, 1/3 will be falling, and the remaining third will be going sideways. This is one of the most common reasons for poor portfolio performance. Having a properly diversified portfolio with 8 to 12 positions not only reduces risk, but the overall cost of constructing and maintaining your portfolio, and it will dramatically increase your returns. So how do I diversify a portfolio without the risk of overexposure? Well, quite simply really. You either have less positions or you gain some exposure into different sectors through exchange-traded funds. Let's face it, for some, finding the right company in the right sector with good upside can be difficult, and in many cases their timing may not be right. A commonly overlooked alternative to stock portfolio diversification is to invest directly into market sector indices. Now, there are a number of ways you can do this, with most common being the ETFs, with other alternatives being options, futures, and other leveraged or structured products. If you are looking to gain exposure to a specific industry or sector without diversifying your portfolio and holding too many stocks, ETFs can be a good way to do this. As a whole, they make your life easier, as the fund manager will manage to do the investing for you. ETFs also significantly reduce the risk of holding any one company, as the fund may hold anywhere from 20 to 30 different companies in that sector. Now, this will allow for good exposure to any given sector. One thing to be aware of when trading ETFs is to ensure that you manage your position like you would with any stock. Most investors will buy an ETF with the belief that it will solve all of their problems, and holding the ETF regardless of whether it is trading up, down, or sideways, and this is unwise. You need to remember ETFs are still essentially managed funds, and fees for running that fund still get charged, and these will affect the performance. Anyone with a little knowledge around direct investing can achieve greater returns and achieve low risk with a properly diversified portfolio. If you are keen to learn how, I'll show you all of this in my new book, Accelerate Your Wealth, which is available online and in all good bookstores. For those in the US, your version is out on the 9th of October. So let's get into this week's stocks. Okay, on your screen right now is a weekly chart of the All Ordinaries Index, and last week, or the week ending the 24th of August 2018. You can see here it closed at 6357, and it did trade a little bit higher this week. It opened at 6426, went up to 6447. As you can see, it went up a little bit higher than the preceding week. It did trade up and then immediately started to fall away through to close at that 6357. Now, this could very well be that 1 to 2 weeks down that I was expecting, or have been expecting for the last month, and it just really hasn't fallen away. And I thought reporting season would be the catalyst to be able to really sort of push it down for that 1 or 2 weeks, but it really hasn't done that. And we really are overdue, because we've had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 weeks up. That's really unusual to get that many weeks continuing to make higher highs all the way through, except the only bar that hasn't made a higher is this one here. And this one here, 2 out of 12 weeks, it hasn't made a higher high, which is really a little bit unusual. So what I've done also, you can see this green figures here, which I've taken that low back in, what's that one, April 2018 onto this last week, so the high of last week. And so to me, this is the projection of any downward move. Now, it might be 1 week, maybe 2 down weeks if it does do that, but we are really overdue for a couple of weeks down. And we can see here there's a couple of, oops, there I was clicking on whatever I did then. As you can see, back here we had a couple of weeks down. Same sort of thing. That's really all I'm expecting. I'm not expecting too much. It may not even get down to that 6,213 points. It may get down to roughly around where my pointer is, that previous high at 6,256, but I wouldn't expect too much. But we'll know pretty quickly this week if it is going to move down. Now, I just want to show you the monthly chart just to give you an idea of what I'm thinking. Now, this monthly chart, I haven't changed since the last time I talked about it. I did talk about this sort of long-term momentum of markets and stocks, how they continually go back to how they travel in momentum. And momentum really is time and price. How many, the market opens and it trades in a day, which is time, and price, it trades in price, and same with stocks. So markets and stocks always will revert back to their longer term average. And you can see here it was moving up and down around this on the upside of it. Now it's moving up and down around underneath this here. And so far August opened at 6366. Had a low of 6323. And currently closing at 6357, as I mentioned before. But it's really interesting, a small little bar. So if I just drag that out a little bit so you can see it a little bit better, you can see here it's only a very tiny bar, and last month it closed at 6366. Currently it's closing slightly lower after moving up. It's really sort of indecision and sort of folding over. So we may even get 2-3 weeks down, 1, 2, 3 weeks down, and may have a downward red bar here. So we might only get 1. I'm expecting maybe 1. I don't think we're going to get 2 in the monthly point, but I still think, I don't know why that keeps coming up. And as I said, it's really about making sure that you've got your own plan, you know what you're doing with your stocks. And I'm going to look at some sectors in a minute, but right now there's nothing to be really worried about the All Ords. I think it's going to be bullish through to the end of this year, probably into the first quarter next year. I still think the targets that I've set before, up around that 66 to 6,800 points is very, very achievable. So let's go and have a look at some of the sectors. The first one I want to look at, and this is where your ETFs that I talked about earlier in the report can help you. And energy is one of those ones that I really, really like. And you can see here at a high in September 2014. And it had its low right down in 2016, and since then it's moved really, really nicely. It's gone from that low of under 7,000, so we're looking at a low of 6,694, and it's almost doubled up to 12,000 in that sort of price. But we do need a little bit of a pullback, and we may be seeing that now. Looking at that right-hand side of the chart, you can see here it's moved up. This bar here is very much indecision. It opened low, pulled right up, and then came right back to close below where it opened. And now it's moving down. But this is a good sign in terms of it's about opportunity. And I'm serious when I say to people that people who don't know buy at the top and sell at the bottom. And the thing is, you should be looking at what's going down, not as much as what's going up. And what you're wanting to do is get on the run. At this point in time, this is getting a little bit cheaper. But if you were looking to buy an ETF, the energy sector is one of those places that I would look at. I still think it's medium to longer term bullish. The energy sector is something there that, even though there's a lot of things going on with the government now with the energy guarantee and everything else, I still think this is a sector that is good for investing. So whether you're looking at individual stocks, which is I prefer to do, and a lot of people do. I don't. Whilst ETFs are great, they really are for people who don't want to put the time and effort into managing their own portfolio and picking stocks. Stocks will perform better than an index, and the individual stocks will perform better than an ETF. There's no doubt in my mind if you pick the right stocks, but it's just understanding how to do that. Financials is another area I like, and I'm not bullish on it, but the banks have been, while the Royal Commission has been on, they've been a little bit subdued, and all the banks had their highs in March, April 2015, and you can see here how the sector had this exactly the same, and it did move up close to that area in May 2017 before falling away. And currently, like last week, you can see very, very bearish on the banks, where they opened at 6445 and had a low of 61290 and closed at 6153. They're always in the news, and they will continue to be in the news with this Royal Commission. But really, the banks have made all of their decisions a long time ago. The Royal Commission didn't come out of left field for them. They already know what they're doing. Yeah, they've divested. Some of them are divesting their wealth management divisions, but that's not going to stop them making money. And it really is just about settling. I still think medium to longer term, good stock, good sector this one is, and it will always perform, and does in any market. The financials are the big performers. So if you're more of a longer term investment, having an ETF in the financial sector is always a good way to go. The materials has been one of the little stars, very much like the energy sector. You can see here how it had a big high back in 2008, a big low down in 2016, and been very, very bullish, pretty much doubling in price, just like the energy sector. This is mainly BHP, your Rios are the huge ones in there. Fortescue not as big in the sector, and Fortescue's been a little bit more hit. It may be more of an opportunity. BHP and Rio are going down a little bit at the moment. Nothing too big to worry about. It is retracing a little bit, but it looks worse on this right-hand side, doesn't it? From this 12,585 high down to the low down there at 11,407, sorry. But you can see on the right-hand side, the left-hand side here, doesn't look as big on here on your monthly chart, but it's just doing a bit of a retracement, and I think it's going to move solidly up over that medium term. So again, an ETF in the material sector would be a nice little decision to make, and or better still, looking at your BHPs, your Rios for when they stop falling and start to move back up again, because they'll make you more money than the actual sector itself. Telstra is another one, or telecommunication. And I say that because really the telco sector is Telstra, even though we are seeing things like TPG getting bigger and bigger, because TPG, own AAPT and IINet, and I think there's been a takeover sort of rumours on TPG. That's all part of this little bit of a run-up, but Telstra really runs this sector. But it is interesting. It did come down to this low a couple of months ago in June, and if you look at Telstra, that's pretty much very, very close to its all-time low price. So it's all-time, people didn't want to sell it lower than that price, and I think it was through 255 or 355. I just can't remember right now. But if you look here, in July we had a high of 1048. We had a higher trough here in a little bit later in July, and then this bar broke through that previous peak, which was that 1048 we talked about. That's a Dow theory entry, simple, and Telstra's done one in terms of that. So, and as you can see, it's done very, very, very well. So there's about 20%, I believe, in that run already. So it's done quite well just on Dow theory. So again, looking at medium to longer term, I think an ETF in the telco sector would be quite great. Now let's just look at one more. This is consumer staples. This one, when the economy is good, it just keeps trucking along, and you can see it's quite different to the other three that I showed you, in that it's making all-time highs, and it's continuing to make all-time highs. It did have a major low back in 2016, and it's run. It just moves up, comes back, moves up, comes back. So right now it's looking a tiny little bit weak, and I would expect it to probably break below that low of 11,173 over the coming weeks. But again, medium to longer term, an ETF in the consumer staples wouldn't be a bad idea. It is looking, I think there's a lot more legs in this one, especially right now with employment. The economy's looking really, really good. There's a whole range of good positives in Australia at this point in time. Interest rates are low. There's just a whole lot of good stories to be had. There's a lot of turmoil in the government, as we know, and I don't think that should deter us. I think we've had some great budgets. I think whilst we're really annoyed about changing leaders and everything else, I think the financial management of the country at the moment is okay.
I'm not being pro-Liberal or pro-Labor at this point in time, but I think, at the moment the budgets are looking good, things are happening. Businesses are getting a little bit more confidence at this point in time. More employment's happening, so they're all good signs for the economy, and it is moving along quite nicely. So, outside political issues, I think from a point of view of looking at how the market's going to perform, I think the market's bullish. It's pretty much as simple as that. So, that's it for me this week. Again, if you need me to look at some stocks that you might own, please let me know. You got a comment down below. If you got questions, please comment below. Also, remember I'm doing these for free for you to help you out and give you some really solid education and understanding. So please help us out and like these videos that we're doing and put comments on it, and also share them with your friends, because that really does help me to do it, because they really take a while to do these recordings. And it's the 3 or 4 people doing them in terms of putting it all together for it all. So really help us out so we can keep doing those, and by sharing it with your friends, that really helps us out, and I can keep doing these for you. So good luck, good trading, and I'll talk to you next time. Bye-bye.
What are your thoughts? If you've got any questions, please comment below. Go and listen to our Talking Wealth podcast. They're available on SoundCloud and on our website. Now, they're jam-packed with valuable information which will help you elevate your trading. Now, if you're serious about learning to trade the share market and you'd like more information about our courses, please click the link in the video description below. Thank you very much for watching this video. If you've liked the video, remember to subscribe to keep up to date. I'm Dale Gillham, the Chief Analyst here at Wealth Within. Goodbye, good luck, and good trading.